As Warren Buffett said, if you don't find a way to earn money while you sleep, you will work until you die. Obviously, one way of earning money while you sleep is to invest in the stock market. In today's episode, I will share with you 12 baby steps to get started. So, if you are ready, let's do it. Number 1 is to educate yourself. Before you start investing in the stock market, it is essential to understand the basics of the stock market, including how it works, the various investment strategies, and the different investment vehicles like stocks, bonds, ETFs, and many more. There are a lot of books about these topics and they are also available online. However, you don't have to read everything before getting started. Learning is a continuous process and it can go side by side while investing. Number 2 is to set a clear financial goals. Determine your financial objectives or the reason why you want to invest, whether it's saving for retirement, or a capital to start a business, or buying a home. Your goals will influence your investment strategy. For example, if you are saving and investing for retirement, your investment strategy and risk tolerance may differ if you are retiring in 20 years compared to other investor who is retiring in 5 years. That's why it's important to set up your financial objectives. Number 3 is build an emergency fund. Investing in the stock market is a long-term endeavor. So, before you start investing, ensure that you have an emergency fund. Many experts are suggesting an emergency fund of 3 to 6 months' worth of living expenses in a liquid and easily accessible account. However, this can also be done on a monthly basis side by side with investing, and it should be replenished immediately when used. The reason for this is to protect you from unexpected expenses and the need to withdraw investments prematurely. Number 4 is pay off your high-interest debt. It is not a good idea to start investing if you are carrying a considerable amount of high-interest debt like credit card or payday loan. It is better to pay it off first because the interest in your debt is often higher than what you might earn from your investments. This does not mean that you do away from using credit card at all, but the good practice for credit card is to pay in full your balances every end of the month. Number 5 is create a budget. Develop a budget to manage your expenses and determine how much money you can comfortably allocate to your investments each month or every payday. Allocating $100 or $200 every payday may not look that much, but if you had been doing it for 5 years or 10 years, you can see the big difference every end of the year. Consistency is the key when it comes to long-term investing. Number 6 is choosing and opening an investment account. At this stage, you are now ready to open a brokerage account or popularly known as trading account. If you are in Canada and you want a commission-free broker, try Wealth Simple Trade, but they don't have a desktop version, so just use your phone. Questrade is also good per my experience, but if you have an existing account with the big banks like TD Bank, BMO, RBC, CIBC, and BNS, you can also use their respective trading platforms. Also, I would suggest that you open your investment account under RRSP or TFSA. As Canadians, I assume that you know the advantages of these accounts. Number 7 is selecting and buying your stocks. You can choose to invest in individual stocks if you have strong understanding of the specific company or industry. Otherwise, consider a low-cost index funds or exchange-traded funds that tracks a broader market indices like the TSX in Canada or the S&P 500 in the US. Number 8 is start small. Start investing in small amount. Begin with an amount you are comfortable with, an amount that you can afford to lose. Losing money in the stock market is inevitable, and if you do, take it as a tuition fee on your learning process. You can gradually increase your investments as you gain experience and confidence. Number 9 is diversify your portfolio. Diversification is the practice of spreading your investment across different asset classes and industries to reduce risk. Consider a mix of stocks, bonds, and other assets. Mutual funds and exchange-traded funds can also be a convenient way to achieve diversification. Likewise, investing in other countries like China and the Philippines is another form of diversification. Number 10 is to have a long-term perspective. Stock market investing is generally a long-term endeavor. While it is important to monitor your investments, avoid making hasty decisions based on the short-term market fluctuations. Some rookie investors are rattled when the market is going down and are tempted to sell at a loss, not knowing that it's just a temporary market corrections. Number 11 is stay patient and disciplined. As mentioned earlier, investing is a long-term commitment. It is important to stay patient and disciplined, especially during market downturns. Avoid emotional reactions to market volatility. As Warren Buffett said, the stock market is a device for transferring money from the impatient to the patient. Finally, number 12 is stay informed and continue to grow. Keep up with financial news. The stock market can be influenced by economic and geopolitical events. Likewise, continue to educate yourself. Learn from your own mistakes and the success and mistakes of others. The most important investment you can make is to invest in yourself. Well, that's it, folks. Thank you for watching, and please like and subscribe to this channel. Remember that money cannot buy happiness, but poverty cannot buy anything. Adios.